If you sold a home in Canada anytime after 2016, there is one specific tax form that can decide whether that sale stays tax-free or turns into a $115,000 bill from the CRA. It is called Schedule 3, and most homeowners have never heard of it. For decades, Canadians grew up believing the family home was exempt from tax by birthright. You sell it, you keep every dollar, no forms, no questions. That was true once. But since the 3rd of October 2016, the exemption stopped being automatic. It became conditional on reporting. Miss that report, and the CRA has the legal room to treat your entire home gain as taxable income, the same way it would tax a stock sale or a rental property. You may have already seen the headline attached to this video, the one about a $115,000 penalty. For a retiree in Ontario or British Columbia sitting on a $500,000 gain, that number is real. It is not clickbait. It is basic math at a 46% marginal tax rate. But is that your situation? Most people watching this are not in the top bracket. And the honest answer is your number could be far smaller or, in a different way, worse. Here is what we are covering. The exact penalty math for your income bracket, not the scariest one. The 3 traps that hit people hardest later in life, especially after losing a spouse. And the fix in case a sale from years ago was never reported, before the CRA's clock on that file runs out for good. If you have spent 30 years paying down a mortgage only to find the finish line moved without telling you, stick around. This channel exists to keep that money in your pocket, not the government's. Here is the part almost nobody knows about the CRA's audit clock. Normally, once you file your taxes, the CRA has 3 years to come back and reassess you. After that window closes, in most cases, the file is closed for good. But that 3-year clock only starts if you actually reported the transaction in the first place. If you sold a home and never filed the paperwork, the clock never starts running, which means a sale from 2017 can still be reopened in 2037, 20 years from the sale, with interest stacking the entire time. I have watched people find this out the hard way, sometimes from a letter arriving 5 or 6 years after a sale they assumed was long forgotten. Before the 3rd of October 2016, you genuinely did not have to tell the CRA anything about selling your principal residence. Now you have to file Schedule 3, the Capital Gains Schedule, and Form T2091, which designates which years the property counted as your home. Skip that step and the exemption is not automatically lost, but you have handed the CRA the option to deny it later, on its schedule, not yours. The reason this changed traces back to the 2016 federal budget. The government had been watching people quietly use the principal residence exemption on properties that were never really their home, sometimes flipping a condo, sometimes claiming a vacation property as the main residence for a single tax year just to dodge the gains tax. Reporting the sale is the CRA's way of making everyone show their homework, not just the people trying to game it. Take the worst version of this. Say you sold a home with a $500,000 gain and the principal residence exemption gets denied on that sale. Only 50% of a capital gain is normally taxable, so $250,000 gets added to your income. In a province like Ontario, once your income crosses into the higher brackets, your marginal rate lands around 46%. Multiply that out, and you land on $115,000 in tax on a sale that should have cost you nothing. That is not a late fee. That is the CRA treating a home you have owned for most of your adult life the same way it would treat a stock you day traded. But before you assume that number is coming for you, slow down. A 46% rate only applies once your income is already high, and most people retiring on CPP, OAS, and a modest workplace pension are nowhere near that bracket. The more useful number is not whether the $115,000 headline is true. It is what that same math looks like once you plug in your own income, and it moves more than most people expect. The $115,000 figure only holds up if two things line up at once: a $500,000 gain and a 46% marginal tax rate. Most people watching this have neither, so it helps to run the same math using a bracket that actually matches retirement income. Picture a retiree in Nova Scotia living on CPP, OAS, and a small workplace pension, adding up to about $45,000 a year. Say she sells a home with a $200,000 gain and forgets to file the reporting form. Only 50% of that gain counts as taxable, which adds $100,000 to her income. Combined with her $45,000, her total taxable income for that year jumps to $145,000. Run that through the actual brackets instead of a flat 46%, and the tax hit lands closer to $38,000, not $115,000. Still painful. Still a number that would genuinely make anyone feel sick to their stomach. But it is far below the headline figure, and that gap matters when you are deciding how urgently to act, and how much money to actually set aside if a past sale needs fixing. Call this the retiree tax bracket filter. Instead of asking whether the $115,000 headline is scary, ask where your own total income actually lands once a gain gets added on top of CPP, OAS, and any pension income you already report. That shift from a flat scare number to your real bracket is the difference between panicking over a figure that was never yours and knowing exactly what a mistake would cost you. I used to tell people not to worry about this if they only ever owned the one home they lived in. I was wrong to say it that simply. The CRA now matches its own records against provincial land registries, so a sale gets flagged almost as soon as the deed changes hands, sometimes before the moving boxes are even unpacked at the new place. That data matching, mortgage records, title transfers, provincial assessment rolls, feeds back into CRA systems automatically now, which is exactly why the old assumption that a sale could quietly go unnoticed no longer holds. The tax itself is not the only cost sitting on the table. Filing late carries its own separate charge, $100 for every complete month the reporting sits unfiled, capped at $8,000. That fee applies whether or not you owe a cent of actual tax, because it punishes the missing paperwork, not the profit. Filing costs an afternoon and a phone call to whoever does your taxes. Not filing costs nothing today, and possibly a great deal later, with a meter running the whole time you did not know it was running. None of this means every retiree needs to panic and call an accountant tonight over a sale from years back. It means running the actual numbers, your actual income, your actual gain, before deciding how big a problem you actually have. Most people land somewhere between a modest late fee and a manageable tax bill, not the worst-case headline. Even once you have run your own numbers, and they land nowhere near $115,000, there is one group of homeowners still at real risk of losing the exemption altogether, and it is not the group you would expect. It is people dealing with the loss of a spouse. Consider Margaret. She is 64. Her husband passed away in 2024, and together they had owned their home for 40 years. In 2026, she decides to downsize into a condo, and like most people in her position, she assumes the tax exemption on the family home is simply automatic. It is not always that simple anymore, and this is one of the most common places retirees get caught, not because of anything they did wrong, but because grief does not leave much room for paperwork. If the home was held jointly or solely in her husband's name, the exemption for the years after his passing has to be claimed under different rules than the ones that applied while they were both alive. The CRA still allows the exemption to carry through, but only if the designation is filed correctly for every year of ownership, hers and his combined, not just the years since the sale. This is where it goes wrong. If the estate takes time to settle, or if Margaret moves out and lets the property sit before it sells, some of those years can end up falling outside the exemption entirely. Add a delayed probate process, a property that needs repairs before it can list, or simply the fact that grief makes months disappear before anyone starts packing boxes, and that timeline slips further than anyone intended. The CRA is not targeting widows and widowers on purpose. The rule was simply written around a single owner filing in a single tax year, and a death in the family rarely moves at that pace. The fix here is mostly paperwork, not strategy. When Form T2091 gets filed, it needs to correctly show every single year both Margaret and her husband occupied the property as their home, not a shortened version that only covers her time as sole owner. Get that detail right, and the exemption holds. Get it wrong, or skip it because the whole process already feels like too much, and part of that gain can become taxable years after the fact. If you are in this position, or you know someone who is, it is worth saying plainly. Feeling behind on this is not a personal failure. Most people are not thinking about tax forms in the months after losing a spouse, and the system does not make allowances for that, which is exactly why it is worth getting right once things settle. Death is not the only life event that quietly triggers this kind of confusion. Plenty of retirees trip the same wire by accident simply by moving into assisted living sooner than planned. And that one has nothing to do with an estate at all. Now picture a different kind of mistake, one that has nothing to do with paperwork you forgot, and everything to do with timing you never thought to question. You buy a condo to downsize. 10 months in, the stairs to the parking garage turn out to be worse than expected, or a knee gives out and you decide to move again, this time into a bungalow. You sell the condo, and because you genuinely live there, you assume the sale is tax-free the same way it always has been. This is the part that catches most people off guard. Since 2023, the CRA treats any residential property owned for less than 365 consecutive days as a flip, regardless of why you sold it or how honestly you intended to live there. Once a sale falls inside that window, the profit is not treated as a capital gain at all. It gets reclassified as business income. That distinction changes the math completely. On a capital gain, only 50% is taxable, and the principal residence exemption can wipe out even that. On business income, 100% of the profit is taxable at your full marginal rate, and the exemption does not apply at all unless you qualify for one of a short list of exceptions, things like death, disability, a job relocation, or a marriage breakdown, and those exceptions need paperwork behind them, not just a memory of why the move happened. Say you cleared $50,000 moving out of that condo. As a capital gain with the exemption applied, that is $0 in tax. Reclassified as business income under the 365-day rule, you are paying tax on the full $50,000, no 50% reduction, no exemption at whatever bracket that pushes you into. The person who knows this rule exists checks their closing date before listing the condo, or documents the health reason the moment it comes up, because a genuine life event exception can still protect the sale. The person who does not know it exists finds out from a reassessment letter within a couple of years, with interest already attached. So what do you do if you already sold something inside that window and never flagged the profit as business income the way the CRA now expects? There is a way to get ahead of it, but it comes with a real deadline attached, not a scary one, just a real one. If anything in the last few minutes made you pause and think about a sale from a few years back, here is the actual sequence to work through in order without turning it into a bigger project than it needs to be. Start by looking back at your tax returns from 2017 through 2025. For any property you sold in that window that was not your only home for the entire time you owned it, or where you are simply not sure the paperwork got filed, check whether Schedule 3 shows up for that tax year. That is the whole first step. You are not fixing anything yet, just checking. If you find a gap, The Voluntary Disclosures program is the route that protects you the most. But the timing matters more than almost anything else here. It only works if you use it before the CRA contacts you first. File through that program ahead of any letter arriving, and it can waive both the $8,000 late filing penalty and the separate 50% penalty the CRA applies when it decides an omission was more than an honest oversight. Once the CRA reaches out to you first, that door closes and you lose the ability to come forward voluntarily. If the gap is small, and honestly just something that slipped through during a busy year, a T1 adjustment is the more direct path. It is a straightforward correction to a past return rather than a full disclosure, and it fits a situation where nobody is worried about anything beyond a missed form. I have sat across from people who spent $500 on a nice sold sign for the front lawn, but would not spend $200 to have an accountant double-check their Schedule 3 before filing. Do not be that person. The $200 question is some of the cheapest insurance you will buy all year, and it is a lot cheaper than finding out the hard way which category you fall into. Before you actually pick up the phone about any of this, there is one thing that stops most people from making that call at all, and it has nothing to do with money or how complicated the forms look. It is the most dangerous part of this whole situation, mainly because nobody talks about it. That thing I mentioned is the pattern that shows up again and again in people who put this off for years, sometimes for a decade or more. Call it audit paralysis. The thinking usually goes something like this. If I file a correction now, I am the one poking the bear, and maybe the bear was never going to notice me in the first place. That reaction is completely normal, and it is not a sign of weakness or carelessness on your part. The CRA is an intimidating institution by design, and after a lifetime of paying every bill on time and filing every return without being asked twice, the idea of voluntarily opening a file feels like inviting trouble into your own living room. Nobody wants to do that to themselves. But flip the framing for a second, because it changes the whole decision. Filing a voluntary disclosure is not poking the bear. It is building a cage around it on your own schedule before anyone else gets involved. Once you disclose on your own terms, you take away the CRA's biggest advantage in this entire situation, the element of surprise, along with an open-ended reassessment window that could otherwise sit there for 20 years waiting to be used. The moment you tell them yourself, that particular clock stops working against you. If you want more of this, the kind of plain walkthrough that turns CRA rules into something you can actually act on instead of just something to worry about quietly, staying subscribed means you will see the next one the moment it goes up. So let's bring this back down to earth. The $115,000 number is the worst case, and for most people watching, it is not your case. But the $8,000 late filing fee and the risk of losing part of your exemption altogether, those are real for almost every homeowner who has sold a property since 2016, whether the gain was large or small. You do not need to become a tax expert to get this right. You need to be a reporter of what actually happened on the correct form in the correct year. File Schedule 3 and Form T2091 when you sell. Get the years right if an estate is involved, and check your closing dates before you sell again. That is genuinely most of it. If this helped you feel less in the dark about your own home sale, subscribe to Brian's Canadian Retirement Playbook, and I will see you in the next one.